we got to talking about our work down there, and then they were like, it's time to go on stage. So anyway, thank you all for being here this afternoon and lending your time and ears to being a part of this conversation. My name is Will Butler. I'm the Senior Director of Global Portfolio at Unreasonable Group, based out of Boulder, Colorado, with offices a little bit everywhere. And I must say, I'm incredibly honored to be asked to facilitate this conversation. I was that kid in uni who sat in the front row and just raised his hand the whole time asking questions. So to be able to get to do that here is a real joy and a real privilege. I guess there's a little bit of background on my own work. At Unreasonable Group, we support a community of over 350, I believe at this point, growth stage entrepreneurs, each of which are addressing social or environmental impact at scale. We work with multinational institutions to discover profit in supporting businesses like these. And we also operate as a bridge between our entrepreneurs and our investment community around the world. So we support our companies in their capital raising efforts. As I was just mentioning to Laurie, who's about to come on stage in a minute, we recently launched a product, I guess about a year and a half ago, called Unreasonable Collective, that also gives accredited investors the ability to pull capital and invest directly in the types of businesses that we support and work with at Unreasonable. So yeah, that's a little bit about me. This conversation about rethinking sustainable investment is something we talk about and think about all the time at Unreasonable. So it's really, like I say, it's a gift to be able to do this. We're going to cover a few different topics over the next hour and 15 minutes, which I'm confident will fly by. So it'll range from actually how do you quantify, how do you measure impact? What are the gaps in the investment ecosystem at the moment? How are banks thinking about it? How are individual investors thinking about it? How are corporations thinking about it? I also have the honor of then inviting Kevin Tayebaly up to the stage, who is the co-founder of ChangeNOW, and thinking how ecosystem players like this are bringing people together to support this community, to push sustainable investment forward. And once again, thank you all for joining and being a part of this conversation too. I guess it would probably be helpful for the panelists coming up if they had a feel for the room too. So if you wouldn't mind a show of hands, I'm just going to ask a few questions, and maybe some fit for you, maybe some don't. But I'd like to know, just are there members of the investment community or finance professionals in this room? All right, cool, friendly audience. Maybe folks from entrepreneur or work in ventures or kind of in that startup ecosystem. Anyone out there? Great. Maybe ecosystem players, whether that's an accelerator program, university program. There we go, guys. Some of my colleagues out here as well. And how about any folks from academia? Any folks from the university system? All right, cool. We may not get too wonky then if there's only two of you, but we'll see where the conversation goes. Well, with that, I guess I'm going to sit down and I will welcome this panel up to the stage. And Laurie, I'm going to start with you, or maybe just all come up at once. We don't have to. Sounds good. Well, I guess before we get going here, it'd be probably wonderful to introduce ourselves. Olivier, I'm going to start with you. Just a little bit about yourself, your work, and also why you're excited about this conversation.
Thank you, Will. Thanks for having me here. I mean, it's a very big and very high-energy event, so it's great to be here and speak about sustainable finance. I'm Olivier Vinciguerra. I'm the co-founder and chair of GreenRWA. So I'm going to try to explain in very simple words what we're doing. GreenRWA is an association rooted in the belief that banks have a key role to play in the financing of the energy transition. So we're trying to support and sometimes push banks to be more involved, and I think we can see in the last 2 years that this has changed a lot if you look at the net zero plans and the commitments of a lot of banks. And the way we are doing that is really through risk management. So we see banks as risk engines, and we are developing new modelization to help understand what are the climate risks that are embedded in the portfolio of banks, physical risk, transition risk. And we're publicizing these models and hopefully, get the community of banks and central banks to use them, understand better their risk, and in the end, change their portfolio and finance more of the investment we need, the massive investment we need over the next years. Hope it's clear.
Amazing. Thanks for being here. Laurie, over to you.
Great, thanks. Well, it's it's a delight to be here. My name is Laurie Spengler, founder and CEO of Courageous Capital Advisors, and we are a specialist impact advisory firm. Really think of us as an impact investment bank. We structure investment products primarily in the private asset classes and bring them to market, raising capital on behalf of entrepreneurs as well as asset managers who are deploying the capital to generate the impact. I also spent a lot of time in field building. I know we're going to talk about that, Will, because I think if you're a practitioner in this area, you also really are obliged, I would argue, to spend time building the field. So I serve on the Global Steering Group of Impact Investing and served on the G7 Impact Task Force at the end of last year. And my motivation for this conversation is that for me, money is a means to an end, and the end is in service of people and the planet. And for me, especially today in this conversation, I'm delighted that climate has attracted so much attention, but unless we embed people, principles of inclusivity, principles of fairness, principles of equity, where that money is flowing, we won't have long-term sustainability. So my motivation in coming to these conversations is really how do we integrate climate and people, climate and inclusivity. It's not either or, it's the combination. Thanks.
Amazing, thank you. Emmanuel, over to you.
Thank you, Will. Hello, everyone. I'm Emmanuel Parmentier, managing partner at INDEFI. So INDEFI is a strategic consultant working for the asset management industry. We work both for asset managers and asset owners. And we are a team of 85 people in Paris, New York, and within this relatively small firm, 85 people, I'm managing a team of 25 people working only on sustainable finance. So we help asset managers, asset owners to progress in their sustainable journey. And so my motivation here today is to discuss, asset classes or type of investors that are below the radar, usually, not the big names, so private assets, private equity, LBO, venture capital, private debt, also family offices that are joining this conversation and are leading also in some aspect the sustainability journey.
Amazing, thank you, Emmanuel. I guess the general prompt is how might we, advance sustainable investment. But I'll start with you, Emmanuel. I mean, how are you thinking about sustainable investing, and how do you measure that impact?
Yeah, well, first, word count. So why sustainable investment and not ESG or impact? How we interpret this move from ESG to sustainable investment is, I think it's interesting to understand that. So a few years ago, the world was relatively simple. You had ESG investors focusing on ESG risks, so environmental, social, governance risk in the operations of the companies. So they kind of exclude some companies, integrate ESG criteria within investment decisions, and then engage to influence the CEOs of these companies. And then you had also impact investors, different bunch of people, smaller in general, and focusing on the impact of products and services of the company they invest in. And what we call now sustainable investment is a mix of both. So you both analyze the operations of the companies and the impact of their product and services. And why is it really important? Is because now it's a matter of value creation. So if you're discussing the impact of product and services, the green share of the business, that's where you create value. And the nicer example of that is the brown to green strategy. So you buy a company, you transform it into a green company, and you sell it to a bigger impact fund. And these people have money now. They have raised really big impact funds, and they can pay you a lot of money to invest in these companies. So measurement is key, but transformation is more important.
Amazing. Thank you for sharing. Olivier, I'm going to bring it over to you to actually follow up on that. I'd love to hear how you're thinking about it, too, with GreenRWA and your team there.
So I think, in Europe specifically, there is quite a simple way, or at least one way, to look at what sustainable finance is about. And I will take the angle of the EU taxonomy. So basically, I don't know how much you know about it, but basically the EU taxonomy, which is imposed now both to corporates and financial institutions, is a green dictionary. So it's about defining what is green, what is non-green. And corporates, for example, have to evaluate how much of their revenue is aligned with the EU taxonomy principles under different sectors, which are very impactful from a CO2 emission perspective, like, of course, manufacturing, transportation, agriculture, etc. And it's a very important tool because it gives a definition of what is green. So by definition, a bank which is supporting or financing a company which has a good taxonomy alignment is doing sustainable finance and will help, in a way, give visibility about where we are today, and hopefully, as banks or corporates commit to a higher alignment with the taxonomy, we will see the transformation of the economy, of the banks, and ultimately have a greener economy and minimize the temperature increase that we all are working here about. And I think so the taxonomy from this perspective is very interesting. Of course, it's Europe only, but there are other taxonomies building around the world, sometimes from private group of banks, sometimes from other countries like in China, although I would say that the EU taxonomy is much more advanced. But we see that, you know, we're going to have a common definition on what it is and to impose that definition to everybody so that everybody is at par and is playing on the same level and they avoid kind of arbitrages on the market. So that's very important. I think what's good also with the taxonomy is that it's now, I mean, it's been decided and it will be enforced that it's going to cover all sectors to define which are green, which are not green. So we'll have a clear visibility on the whole activity of an economy. And what's also very important is that it takes into account other criteria, like not harming the environment, but also what they call the minimum social safeguards criteria, which are qualitative for now, but are very important and are necessary to claim the alignment of the taxonomy. And I guess that's a topic, Laurie, you know much more about than me, so I will let you discuss that.
Yeah, please follow up.
So I think I loved your use of green dictionary instead of taxonomy. Taxonomy is not a user-friendly word, so we should call them all dictionaries, not taxonomies. I think but both Olivier and Emmanuel have pointed to, we have a lot of tools out there now that allow us to scrutinize what's happening with our capital. But you do have to ask the questions. We tend to take the view of ESG, ESG plus, and impact, and we are definitely driving towards impact, but obviously meeting people where they are and where they're starting. And I think the criticality is the delineation, not with an attitude of judgment necessarily, even though we would like to see more capital flow to contributing to the solutions that meet the needs of people and planet, which is really where impact sits, but understanding what the capital is doing and most importantly, what it's not doing. And I think we were talking before we came on stage today, some of the criticisms about ESG. We've had all kinds of criticisms about it because there isn't a rigor, there isn't a spotlighting, there isn't accountability, and people are using it a little bit like, I dare say, the SDGs, tagging. This is not about tagging. This is about really looking at the flow of capital and what is happening, what is the change in that community for people based on the delivery of a product or service. And I think the good news as our community and practitioners, we have the tools now. We just have to use them with more rigor, more discipline, and shine a spotlight on the good examples as well as the not so good examples.
Amazing. Laurie, I have a follow-up question in there. You spoke about the need for higher flow of capital. How do we get more traditional funds or family offices involved in this space and focused on sustainability-minded investments?
Yeah, I mean, there's no question we need more capital. The SDG update report from the UN now says that we need $5 to $7 trillion a year, not the $3 trillion that's been cited previously. And part of that, of course, is the pandemic influence as well as our lack of progress across all of the SDGs. We've made relatively more progress on climate than the social objectives, but across the board, we're far behind, which speaks to the need, Will. And I think you're absolutely right. Institutional private capital has to play. We've got to find ways to encourage, invite, support that capital flowing. I think the family offices and foundations that have often been the pioneers and the leaders have demonstrated what the viability is of some of the strategies. I mentioned that in my introduction, the G7 Impact Task Force. I never recommend a report, except that in that report, we really did tackle this question. How do we move institutional investors from where they are now? And I think it is fair to say that risk mitigation instruments, guarantees, insurance products, we have underutilized those in structuring investment products. We know how to do it. We don't need new tools necessarily. We have to weave them together. We hear a lot about blended finance, but some of the most successful examples at scale are funds, aggregated investment vehicles that do have a guarantee or an insurance element. And I would just underscore that's particularly important for emerging markets. And I know we're sitting in Europe today, and a lot of the great entrepreneurs here are based in Europe. But if we look at the disparities in flows of capital, emerging markets, it's shocking. And the trends are going in the wrong direction. And investors, oftentimes, it's the perception of risk that's holding them back. It's a faraway place. I haven't been there. It's unfamiliar. How do I don't have people on the ground. And that's why the risk mitigation tools, I think, are so critical. So to me, ultimately, we need both the family offices and foundations who are continue to be pioneering, as well as institutional capital. But I do think guarantees, insurance products, other risk mitigation mechanisms can accelerate that flow, particularly to emerging markets where we need it most.
Amazing, thank you. Emmanuel, I feel like you had something you wanted to add to that as well.
Yeah, maybe on family offices, because I know that in the US or Anglo-Saxon world, family offices and foundation were at the forefront of impact. But I would say that maybe in continental Europe it was a bit different, but it's changing really fast. And I was very surprised in the past couple of years to get incoming calls from family offices, very traditional families, I would say, because of a generation change that reconsider their view on ESG and sustainability. And what is great working with family offices is that it's a perfect match with sustainability. Why is that? Because they have a long-term view, because they invest in private assets, which are very close to impact and sustainability, because they don't bother with reporting or with satisfying a client, because they don't have clients. They manage their own money. So they have the time, they have the patience, and they really want to make it happen and create value through sustainability. And that's, I think, a novelty, at least in continental Europe. And maybe things are changing faster than we think.
Thank you. Olivier, I know you do quite a bit of work, too, in working with banks and helping identify opportunities. I'd love to see or hear from you as well. How do we better increase this flow of capital into sustainable-minded investments?
From that perspective, I think our approach in GreenRWA is really to say that mechanically, the kind of approach we have about risk engine should change the way banks are financing the economy. So the tricky part here is that, of course, we talk a lot about the tragedy of Horizon, and so the very big difficulty of the climate change challenge is about embedding on the short-term, long-term effects. I think you need to be able to calculate on a very long term, like 30 years, because that's where we're trying to head on net zero 2050, all the effects of a portfolio or an investment, so that you put it right today rather than a very short-term horizon of current policies or current regulation. We're looking at a year time for the Basel Committee, for example, of the economic impact of the capital. So you really need to work on this very long-term and reconcile long-term with short-term, which is sometimes, the necessity for investors or for financial institutions.
Please. Can I just add two quick points? I really appreciate your next gen point. I think you're absolutely right. We're seeing those changes, which are fantastic. I think the long term, you talked about the temporal horizon, and you did as well. I think it's critically important. I was earlier this week speaking to an institutional investor in Scandinavia, and I was shocked when she said our time horizon is 40 years, 40. Now, not all investors can have a 40-year horizon, but imagine what you can do with that capital when you do have that kind of long-term perspective. So a little bit longer than the 2, 3, 4-year horizons, I think, is absolutely a need and an invitation. And the other thing I would say about banks, we all have bank accounts. Many of us are investors in banks as well. I do think the push from the public, from consumers, from depositors, can also nudge banks, because we can't just rely on investment capital. Banks are critical to the transition that we need in society, but I think we do need to be a little bit more proactive. There's a group of banks called the Global Alliance for Banking on Values, and that's what they have actually put forward. As regulated financial institutions, their mission is embedded in their business, which is to be part of the solution, not the problem of financing the old economy.
Amazing, thank you. Laurie, I guess one other question in there as well. I'd love to hear your thoughts on what are some of the gaps in the funding ecosystem at the moment. And as part of that too, I mean, in any sort of major transition, there's winners and losers. How do we ensure just transitions as we move into this new world that we're all pushing for?
Thank you for that question, Will. I mean, I think the gaps, honestly, sadly, are everywhere. If we take the SDGs as our framework, I mentioned that we are so far behind on all of them, and then relatively speaking, we're further behind on the social strategies. But where I'm taking some positivity is where we're, again, beginning to combine our objectives. So if we look at adaptation for farmers, previously, if we were looking at ag, we weren't having the conversation about adaptation. It was just a sequestration or a reduction, a CO2 emissions reduction. And I think if we can be combining those types of opportunities, we can see greater progress. So, I mean, I do use the SDGs a lot, not as a way to tag, but to look at where those gaps are. So sectorally, I think it's on the social objectives, education, healthcare, agriculture, were huge gaps. And then if you combine that with the geography, the emerging market point. And I do want to say gender, because it came up in the earlier panel that we were listening to, and I think it's just it is still shocking in this day and age, the paucity of capital that flows to female-led businesses, female-led fund managers. And they're constantly told, but you're a first-time fund manager. Oh, my goodness gracious, if we had said that to men when they were first-time fund managers, we would have never gotten out of the gate. So it's a little bit fatiguing to continue to have that as a barrier. I just want to say one quick thing on just transition. Just transition has been used as an aspirational term that no one can say I'm against a just transition. But what does it really mean, and what does good look like? And so as part of the G7 report last year, we tried to explain what good looks like. And we say you need 3 elements. You need to demonstrate a net positive climate contribution. You need to advance socioeconomic equity and distribution in the transaction, and you need to engage with community voice. And it's that third element that will hold us all accountable, whether our capital is really making a difference or not. It's not easy to do, it's not formulaic, but we all know how to engage. Look at this event we're at today. We know how to engage, but we're not always engaging with communities who are most affected by the changes in the economy, and that's what we need to do more of.
Thank you. Olivier, I feel like you have a response to that as well, or you've been thinking about gaps in the ecosystem.
I don't know if it's a response, because I would support very much what Laurie has explained. But just talking about the gaps and the funding gaps, they are massive. If you look at the latest IPCC report, we're trending for a 3-degree increase by 2100 at the speed at which we're investing today. So the gap is really about speed and effectiveness of investment. The transition plan, if you take the figures of the International Energy Agency, it's $6 trillion that we must invest from here to 2030. We are a bit below 1 trillion today, and we should be on the plan at 5 trillion in a year or two. So you can see that we have a massive gap to fill in the next 2 years. And from that perspective, and you can see it, I mean, if you look again at the plan of the International Agency, we should have by 2030 60% of electric car in the street. And if you look at the reality, I mean, I don't have the exact number, but we're probably way below 10% today. If you same for what we call the retrofitting of buildings. We should have by 2040, 50% of the buildings which are retrofitted to save energy. Today, we have a massive gap there, and we can see that it's going very slowly. So what I think is very important here is accelerate the investment, and you do that by innovation specifically. And I can see, and here, when you come here, it's fantastic, because you see there is about 250 corporates or companies coming with new ideas, new way to invest. And just to quote one I was discussing with today, Accenta, they are coming with this way to retrofit buildings through innovation energy. They are pumping the excess of energy into the soil, and they are reusing it later when you get to winter. And they are claiming that the investment, the return on investment, as we say in finance, is less than a year. So these kind of new technology are able to effectively accelerate the transition. It's going to be critical, and that's also one of the view of our association, GreenRWA, which is to say technology is a big part of the solution for the energy transition.
Thank you.
Yeah, maybe I could add the gaps are also in some asset classes that are a bit far away from sustainable investment. So, but they are advancing. I would take an example of private debt. So loans that are provided by either banks or funds to finance a transaction or to finance a company. Well, a few years ago, they had nothing to say on sustainable investment, zero. Now they created what is called ESG loans or sustainability-linked loans. So the interest rate of your loan goes down if you achieve some ESG targets, which is a great idea. But the main challenge is that when you look at these loans, well, the interest rate goes down only by 5 basis points. So believe me, it's very minimal, not very motivating. The targets are set by you don't know who and are not really related to the business of the company. And third, they are always achieved after year one. So it's not really used in the right way. So I believe that, yeah, they are moving in a good direction, but you need to push them a bit further.
Yeah, I think that's a great example. The tool makes sense, but how it's being applied is limited. I just wanted to double down. I think you make such a good point, Olivier, about the built environment. I mean, I think we really need to look at the built environment. We see a lot of investors putting money into infrastructure, but that's again where you can combine not just a climate consideration, but a social consideration. You look at mass transit, particularly in big cities. We're so far behind with livable and sustainable communities and cities in our SDGs, and we look at urbanization across the globe, and we really have to look much more forcefully. I'm all for technology and technological innovations, and it's so stimulating to be here. But new technology and apps are not going to ultimately address the built environment. We need them both. And the last thing I would say is this is a really interesting and quite controversial trend. Some investors are saying we actually have to invest in the dirty stuff. And out of the Asian Development Bank at COP26, they announced that they were going to form a fund to buy fossil fuel facilities and then accelerate the transition. Because by investors just saying we're not going to invest, somebody owns this stuff. And if responsible investors are not going to lead it to an early decommissioning, then we're really not going to get to where we need to go. I just wanted to share that. I thought it was quite a bold move from the Asian Development Bank.
We're seeing a bit of that in the United States as well with coal-fired power plants and transitioning them. That's incredibly exciting. We have a minute left, so I'll just pose it out there. We've heard words of like tens of trillions of dollars that are needed in order to get to this, address some of our goals. Well, how can this community work together? How can investors better support each other? And I'll pose that to anyone.
Yeah, I can take the first one in about 20 seconds because I leave room for you, leave time for you. Maybe we need to move up sustainability, in the hierarchy of the investors in the asset management firm. So that's what we do. We are strategy consultants doing ESG, not the reverse. So our interlocutors are C-levels at asset management firms, and believe me, they start to understand that sustainability is for real, and you can, make a good, profitable investment strategy based on sustainability and SDGs. So, having the right interlocutor in the room and making, a shift of mindset is key.
I agree with that. Lead, share, allocate. So leadership is sorely lacking, especially in big institutional capital. There's a lot of rhetoric out there. There's a lot of expressions and acknowledgement, but we've got to lead. Share deal flow. Not everybody has to dominate a single transaction. We need all of that capital. Open up the table once you have led and allocate. Dial up your allocations for the things that you say you care about.
Yeah, and just to finish with that, I mean, on the banking side, what we're trying to do in our association with our members, and we are working between US and Europe to try to get banks, commercial banks and central banks around the table to find the right way to look at the risk engine question on climate risk. And it's very important, these kind of institutions, they work as a group, and there is always a balance in the discussion between central banks, commercial banks, and they need to converge to a common and commonly agreed principles on that matter.
Amazing. And with that, we'll close this panel out. Olivier, Laurie, and Emmanuel, thank you so much for lending your time and your hearts to this community, and enjoy the rest of Change Now. Cheers all.
Thank you very much.
I think you... Cécile, up to the stage. Round of applause for Cécile Cabanis. Cécile, I'm gonna have to get some water. These lights are pretty warm up here. Would you like some? Are you good? Okay. Well, thank you, everyone. Thanks for being here. Cécile, I'm really excited about this conversation. I think we're both jet lagged. I think you came from Montreal just recently,
this morning.
This morning. I just flew in from Colorado, so we're going to do our best to have a lively conversation and stay awake throughout all this, but I don't think that'll be a problem whatsoever. This fireside will explore the relationship with corporates and the role of investors to warrant sustainability in this relationship. Cécile, before we kick off, I'd love to just hear a little bit about yourself, your bio, and why you're excited about this conversation. It's a pretty robust bio, so you're looking at me like, where do I start?
No, I will be short.
Okay.
So I joined Tikehau Capital 1 year ago, last summer. I'm a deputy CEO, and I focus especially on ESG impact, human capital and brand. And before that, I was the CFO of Danone. Which is very interesting because you get to see the two sides of the matrix, and you can really be an enabler of trying to reconcile these different worlds and have them work together. So it's very interesting. In a few words, so Tikehau Capital was started by two entrepreneurs in 2004. They had 4 million from friends and family, and 18 years later, it's a 36 billion global asset alternative manager, present in 13 countries with 700 people and 4 asset classes, so private debt, private equity, real estate, and capital market strategy. And because they are entrepreneurs, there is one fundamental motto in the company, which is we create, we don't compete, which is absolutely critical if we want to make the shift, because it's not only technological innovation, it's also innovation on the way we work, innovation on the way we look at short-term, long-term. And I think, and we are convinced that because our mission is to collect global savings and allocate them to support the real economy, in doing that, we have the responsibility and the opportunity to channel that in order to accelerate and ensure that what we do today as incremental become a systemic change that we need.
Amazing, thank you. And thank you once again for being here. I guess my first question is, where's the pressure to focus on ESG and purpose primarily coming from? Is it investors? Is it customers? Is it employees?
But I think I don't like the word ESG.
Okay, yeah.
Because it's everything, and when it's everything, it's nothing. I think today everyone is very clear around the objectives that we need to reach. If you take climate, it's very clear. The trajectory are very clear. So I think today we should move from a reporting focus, constraint focus, incremental part of the job to change the software. Because today we've put additional objectives to companies without changing their framework of operating. Meaning, I'm still on short term, I'm still look at my budget yearly. So for me, what everyone sees as investment for value creation, it's a cost. And it's a cost where I have an envelope where I can probably only do incremental. When it comes to taxonomy and measurement, companies have an indigestion of reporting indexes, and they are not First, they don't use an homogeneous methodology. Second, they are not focused on where you could make impact. So I think we need to reverse the way we go about it and start with what is the intentionality? What am I trying to solve? I'm not trying to solve everything. What am I trying to solve? And that's what we did in 2018. When you look at the climate imperative, it's energy and agriculture. So you say, okay, I focus on energy. It's industry, building, low carbon mobility, renewables, penetration of electricity. So what we do is we do thematic fund with partners, mostly around the expertise of the value chain. And then we set very simple, few objectives, but that will lead to action, and that will lead to action on the overall value chain. Because the other thing is that value chain is very fragmented. So each actor is looking at its own perimeter. And most of the impact are in scope 3 for the companies, so suppliers or clients. It's a collective game. It's your suppliers, but it's also some other people's suppliers. So am I willing to make the investment for others to get the value? So I think we really need to change the paradigm and break the silos and the constraints, or we will not go for the systemic change. So that's what we did on energy transition with Total Energy. And we announced last week an initiative with Unilever and AXA on looking at regenerative agriculture. So we are focused. We are really targeting one very critical value chain, and we want to have a material impact that cannot be permitted in today's constraint by doing incremental progress individually.
Wonderful, thank you. You talk about breaking up silos. What is the role, and what role can investors play in this kind of move towards more purpose-driven capitalism?
But I think it's very heterogeneous today. So some will look at it as something they need to do on top. As far as we're concerned, because this is where I'm the most interested, we are really trying to have the intentionality of maximizing and enabling the systemic change. So the framework is very simple. You create a thematic fund, you go for the intentionality, then the additionality, because companies, yes, they need capital, but they also need to be supported through expertise, through understanding the different complexity of taxonomy, what they need to measure, how they can measure, and we can really help them to accelerate their roadmap on that. So it's the second pillar. The third pillar is measurement, because we all know that we don't manage what we don't measure. And the fourth one, for your clients and for everyone, is going to be reporting and independent assessment. Because to give comfort to everyone that it's not your own objective and you don't serve your own bonus and measurement, you need to give them comfort through independent assessment. Then the particularity we have as well is to make sure that we align interest. So it's not that we are a fund taking money from others and having the right intentionality and support. We put our balance sheet in all our strategies. So 80% of the balance sheet is invested in our strategies with the clients. And if you take the regenerative agriculture fund, the intent is that the three partners I was mentioning will invest each 100 million. So it's not small money, it's significant. But all this topic, it's about collective, so it's about aligning everyone against one objective and KPIs to make it happen.
Amazing, thank you.
So we need to simplify the conversation, I think.
Simplify, but one simplify would do. If you're looking at opportunities, you're looking at investments, what is kind of the ideal board composition, or like the type of boards you're looking for that are really interested in, embedding purpose into their organizations for whether it's internal stakeholders or for their customer base? What makes a good board, and what do you look for?
But I think first it depends on the company,
Yeah.
the maturity, the sector, and the size. But overall, a good board is a board where you can really have a broad set of expertise and have people being able to help on the conversation that we need to have today, both on the mega trends that are coming. So many people will need digital expert, many people will need sustainable expert, international people. So I think it's very much, it's like they were talking about ESG ratchet, and we've been doing that since 2018, and indeed, the objective need to make sense for the company. So what you would typically do is set them up with the company depending on the sector and on the thing. It's true that sometimes for them it's a way to get a bit of a discount, so they're not very much challenging versus the objective, but it's up to you also to fix ambitious but realistic commitments so that it's not easy, not too hard, but it's fair. And that's how we need to make sure that we work together to enable a system that will work. If the company decides, then you will fear that it's one-sided, but working together, and that's where I was talking about additionality. It's not only you give money, and then they have KPIs to report. It's how you help them to define the right one, the right level of ambition. And so, yes, the board is very important, and independence is key to make sure that the interest lies with the companies and not with anything else.
Amazing, thank you. I guess a personal question. What are you most excited about right now in your work or the opportunities that you see out there in the market?
But what I feel, where I'm excited and frustrated is that I think everyone is now quite clear on where we need to go. Still, 2050, yesterday I was discussing with companies and they say, we'll do it next year.
Yeah.
So I think people don't realize the time that we need for the horizon because it's not their usual cycle. But I think where I'm very excited is that what we do at Tikehau Capital and what the finance can do is really build the tools with duration of funds, with partners that can really unlock the system that is a bit bugged today to make sure that we get to the next level.
Right, wonderful. You know, I saw a lot of hands out there when I asked earlier of members from the startup ecosystem. You know, one of the challenges of working in startups is how do you engage with corporates? How do you get them to pay attention to you? It's a lot of our work that we do at Unreasonable is operating as a bridge between our corporate partners and the entrepreneurial ecosystem that we support around the world. Do you have any advice for the entrepreneurs in the room or, you know, people who are supporting these types of businesses of how they can engage and work with major corporations?
Yes, I think now anyway, major corporations have understood that that they need to also care about after tomorrow. So many of them have set up VCs kind of funds. The issue is that sometimes they operated the same way than the business, but I think it's a unique opportunity for them to cross-fertilize with startup, with younger generation, and try to change the way they think and the way they work. So that's clearly a big opportunity. We absolutely need innovation, but in order to reduce by 50% the CO2 emission, most of it will come from existing technology that we need to scale.
Right.
So it's very important that we are not only focusing on tech, but really on supporting company to transition. It's back to your point earlier. It's not that I'm super green because I don't invest in brown. So what do we do with the assets and the people? So we really need to make sure that everyone has a chance to help the system going forward.
Amazing. I have one more question, but I want to hand it over to you. Is there something we haven't talked about that you'd like to discuss with this room about the role of corporations, the role of...
It's a question for the room, maybe.
Yeah.
I think it's. I think what we are not discussing enough is really the how, because we are discussing a lot about the what. We are discussing a lot about measures and reporting, but not enough how we help the system to crack the way it operates today, to make sure that we are all looking at the same thing, and it becomes a positive strategic need to make it happen, and not a constraint and understanding that everyone has to move, but still I have my constraints. So I think we really need, and finance is a huge part of it. So I hope everyone embarked with the journey, on the journey, is to find the solution to change the software of operations. Otherwise, there are too many constraints and too many contradictory objectives that we give to everyone. So,
well, yeah, I mean, a little bit more. Let's pull back a layer on that. I mean, like, what is the how? How do we do that?
but how is really to find different ways of working. So it's typically when we say, okay, let's go about the energy transition. We create a fund, we put 100 million, we find a value chain partner that is very knowledgeable in terms of expertise. We embark family offices, institutional investors, and you have 1 billion capacity only dedicated to decarbonization. And then you invest in companies in order to make sure that you do three things: energy efficiency, penetration of renewables, and low carbon mobility.
Amazing.
So again, it's about making sure that you have an intent that is clear, objectives that are not 1,000, but clear ones, measurable, and that you continue to monitor, and that it's collective. So it's a race against time. It's not a race against each other, and I compete. And so we need to break the silos and go for the collective game. And the collective game only works if you agree at the beginning on what is our common intention. If you don't have that, it doesn't work.
You don't have anything, yeah. So often I'll present on something and I forget to make a request to the room. Is there any way that this room or this community can support you in your efforts at this time?
But they do already.
Okay.
I don't know about community. I think there is a need of reporting, but today reporting is too much focused on the picture while we are in a movie. So we really need to make sure that reporting is targeted on actionable decision. So reporting should help take decision for action. Reporting is not the end game. It's really, I want to do that, so how do I measure so that I take the right decisions? And I think today it's not built that way. So I think we need to make an effort in that. And then how we can support is really to get out of the box and try each of us to get out of what we learn for 20 years on how we were working in each of our corporation and so on, because we ask people to change, but they keep the same constraints. Doesn't work. So we need to move the system.
Can shake things up. Well, on that note, thank you. Thank you for being here. Thank you for making the trip from Montreal, I believe, this morning, and being here. And thank you all for joining this conversation. And
thank you very much.
Yeah, I really appreciate it. Cheers.
And action.
What's
As
that?
would say my boss, action.
Action. Wonderful. I think you can take the remote or the microphone off with you. Kevin, I think the stage is yours. All right, I'm going to ask, this is the co-founder of the whole thing. Round of applause. Let's actually stand up in a round of applause. This is a big deal. Thank you, brother. Thank you for being here this afternoon as well. Kevin, you should be proud. This is an incredible event. How's it feel to be back in physical community again?
I'm proud and tired.
Tired.
It's been an incredible time so far, and I'm really hoping that you're having a great time today and yesterday and tomorrow if you're coming again. Yeah. There's been plenty of amazing content and knowledge sharing over the past few hours, and what I've just listened to really fills me with hope.
Yeah.
So yeah, it's really great to be here, and so I think I'm the only finance non-expert in this room. I'm not a professional, but I've been looking at this space for the past few years. It's really an area that really interests me, and I want to play my part as well with ChangeNOW in the ways I can. And I'm really happy to see how this space has been evolving very quickly. There's clearly been a great shift of mindsets. I think that, and I think Laurie will agree with me on that, because you've been in the space for a very long time. It used to be associated with a kind of a tree-hugging kind of mentality, and not being really taken too seriously by the finance professionals and the people, because who wants to save the planet? Finance is there to make money. And I think we're getting, and I've heard a lot about the intention right now, and I think this is really where I think that's the key question. Finance needs to find its purpose. It needs to find its intention. What is the intention of finance? And I think the things that we've heard are really helping us go in the right direction, which is, I think, it's here to make us understand what is the right society we want to build.
Yeah.
And there are some things where we will all agree, and I think carbon is probably the sector that is the most universal right now, because it's the most measurable. Social issues are a little bit more complex to deal with, but yeah, it's great to see that there's a lot of excitement around this space. I feel like there's as much going on right now as what happened in the tech space a few years ago. A lot of momentum. Investors are feeling as well that you can also be very profitable in this space. If you look at decarbonization, if you look at circular economy, those are sectors that are really booming and growing, and that are very attractive for investors. But the question we could ask ourselves is, is it the only reason why we want to go in this space? And I don't, and that's the elephant in the room. Is double-digit return on investment the right alley for everything? And I don't think it can happen for everything. Right. So the question is, what good of a return of investment is? And yeah, so these are the things that I've been thinking about. I see as well still a lot of deviations as well. If you look at ESG finance today, there are still a lot of things I think we can improve.
Yeah.
If I'm going to be talking here to maybe a crowd that is less aware of what's ESG today, what's happening in ESG today. But like when you look at non-listed and listed companies, when you look at what's happening in the listed world, there's clearly a lack of standards in the way we perceive ESG. If you go in the US, the intention of ESG is to maximize shareholder value by de-risking your investment. ESG is a way to reduce the risks that the company has, because you're going to make sure that you remove some of the externalities from the planet to the company.
Yeah.
Which means that if you look at the way the companies are rated right now by MSCI, for example, which is rating, I think, half of the companies today in terms of ESG performance, well, a company is going to get an upgrade not because it does better for the planet, but because the planet is putting less risk on the company. Isn't there a problem here? Like, yeah. If you look at McDonald's, they got an upgrade on their grade, on their ESG grade last year, not because they were doing better, but because investors considered that they were less exposed to climate risk.
Well, yeah, let me ask you about that. I mean, what are some of the things we should be cautious about right now? I mean, it seems like there is a lot of murkiness in all this, but where do you see that, whether it's finance or otherwise, should be cautious as we move into?
Yeah, I mean, I think that's one of the things, which is this lack of standards. And if you look at what's the way to the intention that you see in the US and the intention that you have in Europe, which is the concept of double materiality, right? So we're going to look at both what are the externalities of the planet on the company, but we're also going to look at what are the externalities of the company on the planet. And there is no single way of looking at these things today in the world. There is not. We don't agree on this right now. There's also a lack of regulation on the ways this performance, ESG performance, is rated, and the way the portfolios are composed. Today in the world, I think 99.7% of the companies, of the world traded companies, are in at least one ESG fund. 99.7% of the companies.
What is the role there? I mean, what is the role of an ecosystem player like ChangeNOW, in affecting regulation, of elevating this conversation?
I mean, we're here as a platform to get, these amazing people here get a voice and inspire more and more people to see that this is not just a niche sector.
Right.
This is the way forward. This is no matter whether you whether you want it or not, this is on. This is happening. And this is going to be the thing we're going to be talking about for the next 30 years. And the people in the room, the people listening to, there are regulators, there are institutional stakeholders, there are lawmakers. They know that when they come here and they see that the people that are here, they've been thinking this through. They've been putting a lot of thoughts and efforts into understanding how do we rate, how do we measure impact investment, how do we make it the next norm. Yesterday we had an event around showcasing the best impact funds, which is called Funds for Change. And we had more than 15 to 16 funds that have very different ways of looking at how to measure it, and a lot of different scopes of investment, a lot of different theories of change. And what's really great here is that we didn't leave this room with an agreement on what was impact, but we left the room with a lot of insights and a lot of new ideas on how we can talk about this space.
Right.
And I think that's the value we're trying to bring, and I'm hoping that's what you're getting.
Yeah. Okay, Kevin, let me back it up just a bit. Putting on an event like this is a tremendous amount of work. I've hosted and convened things myself. This is a year's worth of work into a few days here.
That's right.
What is your why? Like, how did how did this come about, and why is it important to you that this conversation is elevated?
Well, we're a marker of what's happening in the ecosystem. When we started 5 years ago, I think the messages we were giving were, I think I've heard that right before coming here, is we were kind of telling people what they wanted to hear to get them interested by the space. I mean, we had to play smart. We first rented venues that were attractive. Our first event was the newest brand venue in Paris, which is called Station S. And I think half of the people came because it was the venue and not because of the messages we were bringing on stage. And then we started, pushing the theme of impact investment as this field that is going to be as profitable as, the normal financial space, because that's what people wanted to hear. But I don't think now, in 2022, it is a great idea to tell people in impact you're gonna have the same returns as in traditional finance, and because look, in the States, I heard last week a very famous investor in the States, Martin Thiel, who was a founder of PayPal, comparing ESG with communism. Why do we have that? It's because we still tell people that we still tell people that lie that you don't have to make any compromise, and I don't think that's true. And today, as ChangeNOW is maturing, as people are getting more and more technical, they're getting more and more aware of what's happening and the responsibility that we all have here. I think it's time to tell them the truth.
Right.
And we need to be all responsible here. And I think one really valid point that I heard, and we need to stress that even more, it's not just about climate. Everything is interlinked: biodiversity, climate, resources, and humans. The social element is really key.
The S.
You know, if you look at, just look at flower trade. If we want to end up this fossil fuel dependence, it means at some point the world is not going to be as globalized as it is today. It's a fact. If it's less globalized tomorrow, it means that we're going to have to change the way we look at trade. How do you explain people in Kenya, in Colombia, in Panama, who are making more than 1.5, 2 billion euros a year in flower trade? How do you tell them tomorrow, well, guys, we're sorry. I know we've helped you, we've pushed you to invest in those sectors in the past. Well, now we no longer need your flowers because, we can just keep sending flowers by planes, right? What is the social impact of this decision, which is going to be a decision we're going to have to take at some point to be aligned with the Paris Agreement objectives? How do we make this transition just for every sector, every country, every nation? And I think that, as was said before, we lack a lot of capital. We need to send way more capital in the emerging markets. We need to send way more capital with women-leading funds as well. It lacks a lot of diversity, and we've heard that since yesterday morning. And we need to really change the way we allocate capital. Another example, we can't let the markets be free by themselves. We need to let Friedman in his grave, Look at micro-mobility. Micro-mobility, it got 3 billion euros in funding last year, and the impact on the reduction of carbon emission is less than 0.2 gigatons of CO2 per year. Ecosystem restorations got less than 0.2 billion euros in funding last year. It reduces emissions by more than 3 gigatons of CO2. I mean, why is it reversed? Because the markets are not aligned with their impact. Because today it's more profitable to invest in micromobility than it is in ecosystem restoration. So you need regulators to make sure that we guide this reallocation of capital.
I appreciate you talking about that. We don't talk enough about the S in ESG. We don't talk about the social issues. We don't talk about, as Laurie mentioned earlier, these just transitions. It sounds like this is incredibly passionate to you, like the S in particular, and making sure people are at the center of the investments we make, the products we buy. And I'd love to hear just a little bit more about that, how that conversation will continue here at ChangeNOW.
Well, I mean, let me ask a question to you guys. Who are going to be the first victim of climate change?
The poorest. Yeah.
When is it going to happen? 2050? No way, it's happening now.
Right.
You look at refugees and you look at, this is going to put a lot of social pressure. Look at the reason why we had the Yellow Vest movement in France a couple of years ago because of tax carbon. I think the next crisis is going to be social. Let's see what happens next winter. It's not going to be Yellow Vest, it's going to be Red Vest. Because look at inflation today because of the energy crisis we're going through at the moment.
Right.
We need to solve inequalities. And the problem with the S at the moment is when we talk about social, we talk about health, we talk about housing, we don't talk about inequalities. We don't talk about creating a just and fair society that is more sane and that protects people from what's going to happen more and more in the years to come. That's why it's really key. And there is a terrible lack of funding. In Europe, it's 60 billion social bonds per year. There are, I think, 1,100 green bonds in Europe. So it's a 50 times less. We need to rebalance that as well.
Kevin, I really appreciate this conversation. It's not just about excitement and opportunity, but you're also sending up a flare that we have. There's a huge problem here, right? And we need to address it at this stage. Otherwise, we may be encountering, migration issues that we can't address, revolutions, et cetera. Yeah, how is that? That sounds like it's a core part of how you think about this work and you think about your role in this work. How do we get other people to pay attention to this S?
Well, I think actually more and more people are paying attention. It's the first time we're meeting again after 2 years, and I can tell you the people that I see here today are not the same that I used to see 2 years ago. And that's really, really encouraging for us. I had a lot of people coming from decision-making positions coming to me and saying, we were a little bit afraid of coming here. We were a little bit afraid of doing this operation, this launch, or because we're not used to it. You know, we used to, we live in our bubble. We used to seeing always the same people, the same kind of events, the same kind, you know, and where it's a battle of egos. Who's doing the best, and here it's not this. It's about concrete solution. We don't care about who's doing it. It's the solutions and what can happen with it. And they came and they are thanking us. They're saying, this is so refreshing. Like the CEO of Accor yesterday said on stage, it's at the same time, it's annoying and refreshing to know I'm the oldest person in this room.
Yeah.
And it's a real change. And I think that's such platforms, because people are pushing, youth is pushing, the media are pushing as well. It's really what's getting more and more people interested by it. And I think this platform also, because of the great messages we hear every day, I think that's what's getting more and more people interested. And you need passion, you need some kind of activism as well, but I think at the end of the day, it's all about passion and being able to convey those messages with your heart. It's about being genuine, it's really about being authentic and real. And I think that's what all those people are here.
Well, I think that starts with you. I'm getting a very authentic and real vibe as we speak. It seems like you're a very heart-forward leader of this organization. Thank you for that work. I mean, the same question I asked earlier, same for the audience. Like, how can this community support you in your efforts at this time?
I think the best way to support is just to keep talking about it. We need these conversations to happen every day, at home, at work, in the streets, in the bars, in the cafes. We need to be talking about it all the time. You know, I wonder sometimes, why don't we talk about this more often? And I think that's the best way to support this, is to make it a constant conversation. Constant conversation is what's going to make us make progress. And this is what's going to get people in position of power to take more courageous actions. I think this is all about courage. This is all about humility and ambition.
I love that. It's all about courageous conversations at the moment, like being bold and stepping out there and making yourself uncomfortable, but saying what needs to be said.
And if people want to stay relevant, they will need to be on top of this. Trust me.
Amazing. Well, with that, I just want to say thank you once again for convening this, for being so heart forward, keeping these conversations going. And
thank
Kevin,
you.
Until next
year, everyone.
Cheers, everyone.
And really enjoy your time here.
Yeah.
Have a great end of the day.
Thank you. And I guess I've been turned off. I don't necessarily need to close this out, but I'll just say thank you. Thank you all for being here, for being a part of this conversation, for sitting in the front row and nodding your head and smiling. That made me feel comfortable as we were going along. And let's keep these conversations going. These are critical. And from all of my team at Unreasonable, thank you for being here, and thanks for lending your time, hearts, and minds to this conversation. Until next time.